Imagine two people buying the exact same term insurance plan today. Same insurer, same 1 crore cover, same policy term. One of them is 25, the other is 35. Now the question is, what is the right age to buy term insurance? If you are 25 today, a 1 crore term cover can cost you less than 1,000 rupees a month. Wait until you're 35, and that same cover for the same sum assured can cost significantly more. The earlier you lock in your premium, the more you save over the entire length of your policy. The earlier you start, the more you save on your premium every single month for the entire length of your policy. Buying early is simply one of the smartest ways to make your money go further when it comes to term insurance. That is what this video is about. Not just telling you to buy early, but showing you what each decade actually looks like in rupees and in real life situations. And if you're already in your 30s and 40s and wondering whether it is too late, stay till the end of this video because that answer may surprise you. Before we look at each decade, it helps to understand why age affects your premium at all. Term insurance is priced on one core idea: the probability that the insurer will have to pay out a claim during your policy term. The older you are when you buy, the higher that probability because the risk of health complications goes up with age. So the insurer charges more to cover that risk. What makes this important is the premium you lock in on day one stays with you for the entire policy term. If you buy at 25 and lock in a rate, you pay that same amount at 30, at 40, at 50. The insurer cannot revise your premium upward just because you get older. That rate is fixed for the policy term. However, it's subject to changes in applicable taxes as per prevailing laws. This means the decision of when to buy is not just a decision about today's affordability. It is a decision about what you will pay for the next 30-40 years. There is a second factor that people often miss. It is not just about cost. It is about insurability. As you age, the chances of a health condition showing up during your medical examination go up. A high blood pressure reading, a borderline sugar level, a family history flag, any of these can result in a higher loading on your premium, a restriction on your coverage, or in some cases, a declined application. The younger and healthier you are when you apply, the cleaner your underwriting outcome is likely to be. If you are in your 20s and earning, buying a term plan right now is one of the most cost-effective financial protection options available to you. Here is why. Your 20s are typically when your first set of financial dependence appears. You may have parents who rely partially on your income. You may have taken an education loan. Your income, even if modest, is already someone else's safety net. And if something were to happen to you, that safety net disappears. At this stage, your health profile is at its cleanest. No chronic conditions, no lifestyle-related flags. You will clear underwriting with minimal friction. And the premium you are offered at 23 or 25 is the lowest it will ever be for the cover you are getting. In your 20s, you could get 1 crore life cover from ABSLI for less than 1,000 per month. That is less than a typical family dinner out. And that rate is locked in for the entire policy term. There is one more advantage to buying in your 20s that almost nobody talks about: policy term. If you buy at 25 and take a 40-year term, your cover runs until you're 65. That covers your entire earning career. The years your home loan is running, the years your children are growing up, the years your spouse would be most financially vulnerable if something were to happen to you. You get complete coverage at the lowest price with one decision made early. Your 30s are the most common entry point for term insurance in India. And honestly, if you have not bought yet, your 30s are when you absolutely must. Because this is when your financial responsibilities are at their most concentrated. You likely have a home loan or are planning one. Your EMI may be the single largest outgoing in your monthly budget. If you have children, their education timeline is already running. Your spouse, if they are not earning, is financially dependent on you. Your parents may need more support than they did 5 years ago. The number of people and liabilities depending on your income has never been higher. The good news is that the term insurance in your early 30s is very affordable. The premium is higher than your 20s, but not dramatically if you are in good health. What you do lose by waiting from 25 to 35 is compounding effect of that premium difference. If the gap is, say, 300 rupees a month over a 30-year policy term, that is over 1 lakh rupees in additional premiums paid for the exact same cover. The protection is identical, you are just paying more for it. The other thing to watch in your 30s is your health. This is the decade when lifestyle-related conditions begin to show up for many people. If a medical test during underwriting flags anything, your premium could be loaded higher than the base rate. That is another reason why earlier in this decade is better than later. If you're 32 or 33 and reading this, the right time is now, not next financial year. Here is the honest answer for anyone in their 40s asking whether it is too late. It is not too late, but the conversation changes. In your 40s, premiums are meaningfully higher, your health profile is more complex, underwriting will be more thorough, and your policy term options are shorter because the maximum coverage age with most insurers caps out at 65 or 70. But here is the question that actually matters. Do you still have financial dependence? Do you have a home loan running? Are your children still in school or college? Is your spouse financially dependent on your income? If the answer to any of these is yes, then the need for term insurance is real. And the cost of not having it is far higher than the cost of the premium. The purpose of term insurance is income replacement for the years your family needs your income. If those years are still ahead of you, the cover is still relevant, even at the higher premium. What changes in your 40s is the strategy. You want to be precise about your cover amount, aligning it tightly with your actual outstanding liabilities and income replacement need rather than buying a round number. You want to take the medical examination seriously and disclose everything accurately. And you want to act sooner rather than later. Because every year you delay in your 40s adds more to the cost than a year's delay in your 30s did. Here are 3 simple questions I want you to answer right now. First, does anyone depend on your income, even partially? Parents, a spouse, children, a sibling? If yes, your income is already someone's financial plan and it needs a backup. Second, do you have any outstanding debt? A home loan, a car loan, an education loan? If you were not there tomorrow, who would carry that? Third, would your family be able to maintain their current lifestyle and future goals on their existing savings alone? Not for a year, but for 10 or 20 years they would need to rebuild. Remember, term insurance is not an investment you track or a savings plan you watch grow. It is the financial foundation your family stands on if you are no longer there. You put it in a place once, you keep it active, and it quietly does the most important job in your entire financial plan. Wherever you are in your 20s, 30s, or 40s, the most important thing is not which plan you choose. It is up to you to choose now. If you want to understand your options better, check out some of the other videos on this channel which can help you understand everything from how to pick the right term plan to how to calculate your cover to what riders actually make sense for your situation. Start there. The more you know, the better the decision you make for your family. All relevant links including ABSLI term plan options are in the description below, whenever you're ready to explore. Before we wrap up, let us tackle the questions we get asked the most. If any of these have been in your mind, you are in the right place. What should a 30-year-old salaried person look for in a term insurance plan? 3 things matter most. First, a cover amount of at least 10 to 12 times your annual income. Second, a policy term that runs until you are at least 60 or until your youngest dependent is financially independent. Third, an insurer with a consistently high claim settlement ratio, ideally above 97%. What is the right age to buy a term insurance in India? The right age is as early as possible, ideally in your mid-20s. That same cover costs more at 35, and that higher rate stays with you for the entire policy term. Every year you delay is an additional cost your family indirectly bears. If you have anyone depending on your income, there is no better time than today. If you found this video useful, share it with one person in your life who has been putting this off. The like button and subscribe help us keep making content like this. And in the description, I have linked the full ABSLI term plan page so you can explore your options without any pressure.